Hello and welcome to the KE Report. I'm your host, Shad Markowitz, and I'm speaking today with Erik Wetterling, also known as the Hedgeless Horseman. And Erik has the site, thehedgelesshorseman.com, which we will put a link to down below so you can follow along with his analysis. Erik, it's always great getting you on the show, and we're talking today after having had a pretty nice chat off mic here about your visit to the PDAC conference, the Prospectors and Development Association of Canada conference. This is a world-class event. It's the biggest mining event really in North America. It may be one of the biggest events in the world as far as mining. Having been to the convention and come back the other side, what were some of the key takeaways you had from boots on the ground checking out the conference?
First of all, it's interesting the idea that I've heard a bunch of times, a thing called the PDAC curse. I think it has something to do with stocks falling after PDAC or something like that. And I saw some people on Twitter like, maybe we'll have the reverse PDAC curse, and that kind of looks what has actually taken place. But the general sentiment was kind of interesting because, just before the PDAC, gold and silver started to go up, or around the time of the PDAC at least. And the jive I got from people was that, we'll see. And I can understand it. It's like gold has been crying wolf a bunch of times since 2020 now. Going up to 2000, getting slammed down. Going up to 2000, getting slammed down. So what is always interesting, and the same goes for every bull and bear market in equities, etc., is like people believe it less and less the more they have been disappointed for maybe understandable reasons. But at the same time, it's like you should kind of believe it more and more because it showed that gold was actually sticking to 2000. And then it just started to go up, and silver started to go up as well. And basically everyone I talked to doubted the rally. Nobody really believes it. We did see some reaction in the juniors, etc., I would say. But more than that, it's like, I still think that the metals going up, I don't see too much retail participation yet. But I also heard a bunch of, people saying that this guy is here at PDAC, someone that only shows up when it's literally rock bottom kind of thing, the big money vultures, let's say. And I, heard about deals with big sophisticated investors and stuff. So I still think this is way off the radar for most retail. I don't think many people believe it. Even if they're in the sector, they don't really believe it. It's like I was getting excited seeing the metals, but still, you don't get too excited unless the stocks you own go up, because I'm mostly in junior stocks. I'm not mostly in gold. And also, I would say there were quite a few who were kind of diehard resource bulls and investors in the space, but they were also playing around in the crypto space, because that's the one thing that is still broadly working right now and has worked for the last couple of months. It's been going up. So everybody's been having a part in that one. And even the ones that know they own, let's say, shit coins, they still see a trading opportunity. So they got some money in there.
Yeah, Erik, I think it's an interesting observation because there's a couple different groups of investors. And this is what we were talking about off mic, that there's some people that are diehard resource investors all the way, 100% of their money in it. But there's a lot of people that have diversified their portfolio into, and I would throw myself in this camp. Hey, I like resource sector. I'm mostly focused on it. But if there's sectors that are working, if AI is working, or if cryptos are working, or if biotech is working, sometimes you catch the momentum trade in those just for the trade. And there's a lot of people in the resource space that see, hey, cryptos are working. I'm going to trade it and make some money. When meme stocks were working, I traded some of them, and a lot of my friends did, even though that we may still look at resource stocks. Do you think that means that eventually, when we do see liftoff in the resource sector, that some of those people may pull in their horns a little bit from some of those other things that have worked and say, okay, now it's time for the mining stocks, and maybe some of that money flows back into the space? Or do you think that it'll be perpetually distracted by other sectors?
No, I think, if there's something I've learned over the last 7 years in the junior space and just looking at markets overall, it's like I just get more and more convinced that people buy stuff that's going up, that has gone up. And the good thing about juniors with this low liquidity is that it takes less and less of capital to move these stocks. I mean, I have seen some pop 100% off the bottom, and we're talking peanuts amounts. But that's not for every single junior. And the big money, the smart money, the Rick Rules and all of that, I mean, they can't buy in the open market. They buy into placements and the institutions, obviously. So, I mean, they're not setting the prices on a day-to-day basis. That's the retail, and they are still distracted. They still don't want to get into it. Everybody's been turned off by this sector because it has gone down. I mean, let's face it, it's like almost nobody actually buys something because they think it's cheap. They buy something because they think it's going higher, regardless if it's cheap or overvalued. I mean, the crypto space, in my opinion, and most people that are sophisticated and play around with it, they know it's worthless. I mean, there's, I don't know, 15,000 cryptos. I mean, they know it's worthless. They just do that momentum trade. And I think maybe, I mean, Nvidia is starting to take on some water, but the crypto space kind of was the next one up in terms of momentum on the far end of the risk curve. So I think we need to see some kind of an upwave. I think when these juniors are up, when they have gone up, that's when people will get excited again. I don't know what's going to kick that off, but obviously the worse crypto does, the easier it is from a relative standpoint to be performing well. I mean, if Dogecoin goes up 1,000% and your juniors go up 200%, relatively speaking, that's still not good enough. But if we see some kind of chink in the crypto armor and we have some of these juniors start to go up, I think people are going to get back to juniors. And again, like we said, I mean, if even the ones who know how cheap this sector is can't help themselves but to dabble in the crypto space, I mean, think of how the uninitiated, they have no interest in this space. So they will be the real latecomers, of course. I mean, when stuff is up 500%, that's when they get in. But there's still a lot of money on the sidelines, I think, from people in this actual space. And again, the really sophisticated big money, they can't even buy in these low liquidity environments. So we're still stuck with, 3 people around the world dictating the stock prices of these juniors on any given day right now.
Yeah, it really is amazing how low the volumes are and that a few people can move a whole stock valuation just based on a minimal amount of trading. But to your point, I think when some of the excitement comes back in some of the gold and silver stocks, we will see the same kind of action we did in lithium stocks or uranium stocks, where those are resource stocks that did start going into momentum. And then everybody dogpiled into lithium, even after they had already run up hundreds of percent or sometimes thousands of percent. There were still people piling in at the end. We saw the same kind of effect in uranium over the last couple of years, where even after it had run and some of these stocks were up, I was doing some charts, some of them were up 22 times, 30 times, 30x, 3,000%, some of these stocks off their pandemic lows, and people were still piling in. And some of those theses still could keep playing out in lithium and uranium. So I think we'll see that same kind of effect in gold and silver stocks eventually, and then maybe even in copper and the base metals and nickel stocks. But we were also talking, Erik, just about how interesting it is, the mixed messaging that you get from retail punters. When you look at the chat rooms over the last 2 years, 3 years, everybody's been in a despondency state of despair and, oh, this sector is terrible and I can't wait to get out of here. I never should have invested in this sector. And as soon as I can get my money back out, I'm leaving and never coming back. Then we see the metals break out on gold, silver get a bump, and those same people say, why is my stock not going up? Where is everybody? Where are the generalists at? Well, you just got done messaging for the last 3 years that it's a terrible sector. Why would you expect generalists to flow back in right now? So maybe just unpack some of the realizations you've had just being in the chat boards and talking to so many people through your site.
Yeah, I mean, it's exactly like that. I mean, most people I see, I bet like 70% of the followers I've added on, to my Twitter account, for example, over the last at least 2 years. I mean, they probably bought near the 2020 highs. So most people have only seen the downturn in this sector. So that's how they think it is. It only goes down. It's like what Rick Rule said about the silver juniors recently, that people have forgotten that they can go up. So if that's all you've seen, so that's what you think the base case is, that's the only way this market works. It goes down. And they're constantly whining belly aching again. No thought at all to like, hey, how cheap is this? Wow, some people say it's the best opportunity since the 2000s, which would be like the best gift in decades. But that's not the message you're getting. The message you're getting that they have gone down, and that's why this is a shitty sector, not the fact that, oh, they're so low that they're going to go up, so you want to be in here. So everybody's been belly aching. It's like this sector sucks. Nobody should be in this sector. Don't buy juniors. They're all crap. They're all whatever. And that's true in a bear market. And that's true for most companies. It's like, well, let's say 10% are legit. The thing is obviously that when this sector gets going to the upside, same we're seeing in the crypto right now, everything goes up. So I mean, there's two ways. It's like the big money in a sense is like the sentiment ways, up or down. If you're diversified at the top, you're going to be down a lot. If you're diversified at the bottom, you're going to catch the next up wave. But again, they have been telling everyone and themselves, anyone who's willing to listen, that this is a sector you should not be in. It's so risky because everything is down in price. And of course, the opposite would be like, okay, well, during the 2016 rally or 2020 rally, every junior went up like 400%. Does that mean this market is not risky simply because everything was going up in price? I mean, they don't really understand what they're even saying. They're talking about volatility, not risk per se, and they underappreciate just how ridiculous this sector is and how the increasing amount of momentum buyers in the stock markets around the world. I mean, it's become one big momentum machine where it's like a whack-a-mole. Everybody's flocking to whatever is working until it doesn't work, and then they're going to be saying how shit it is, you shouldn't get in here. It takes a lot of time for the sentiment to turn. I mean, a few months ago, I didn't see a Bitcoin tweet for maybe, a few weeks. Then recently I saw tweets from people I don't even follow that was about Bitcoin. And obviously everyone is super bullish now. So I mean, it's the same sector, but it's like the narrative changes depending on obviously if it's going up or down. If it's going up, low risk. If it's going down, high risk. So I mean, this is, in my opinion, the way better one of an opportunity than 2015 because metals are way higher, undervaluations are way bigger, and still nobody uses that almost nobody uses that in their investing philosophy anyway. Nobody that's in the retail crowd. The big money, smart money, they do, but they don't set the market prices. They go into the private placement. So it's just funny. That's like what you said. It's like ironic that they're saying you shouldn't be in here, I shouldn't be in here, whatever. Then metal starts to run, and they're like super surprised why not everyone is like, oh my God, of course I need to own juniors. Well, you've been telling everyone that no matter what, you should not be in juniors. But of course, they're going to be in here when they actually start to perform. That's also the funny part.
Yeah, it's that cognitive dissonance, that weird double-edged sword that we see with investors where they love to hate it and they hate to love it all at the same time. But when the momentum does start in the sector, people will pile in, and price moving up and seeing big gains, even investors outside of the sector will make note of what's moving. And the momentum traders always come into a sector when it starts taking off. I would like to find out just how you're looking at your own portfolio as far as the balance between alpha stocks that have a catalyst and beta stocks that have the optionality to rising prices. We're finally seeing gold breaking out. It's broken about, it's at new all-time highs the last couple of weeks, and it's broken above that ceiling that it was stuck at for really the last 3 to 4 years since 2020. So now that gold is breaking out, a lot of people think eventually that will drag silver higher and you'll see the mining stocks respond. Are you more excited about beta stocks that where that optionality is going to get re-rated higher, or are you still mostly trying to take a rifle approach and find the alpha stocks that have growth catalysts?
I mean, that's a constant internal battle, I was going to say. I mean, I haven't liked beta this much since 2015 when I ended up making a lot of money on beta, and then switching over to alpha when I started to learn more about the sector. Because, I mean, if it is a trading sardine, you have to, I mean, sell it at some point. That's why I also prefer alpha, where it's like, if a company can grow for 5 years, I mean, how much does it matter your timing? Do you need to trade that? No, not really. and even the best alpha stocks. I mean, yes, they have big corrections and all of that, but if they just continue to grow the fundamentals, the prices sooner or later, and that might take a year, or might take 2 years, depending on how depressed or how big the sentiment swings are in the sector overall, you're probably going to work out, it's going to work out fine for you. But I know myself now, I mean, back in 2015, I didn't fully know how crappy the stuff I bought was. And it's obviously, like we said earlier, everything goes up in a bull leg or in a bull market. The crappiest ones go up the most. I just know I hate that. That's why I can't touch crypto, basically. I hate the idea of knowing that I put money into something that I could buy whatever with, but I bought something that I don't think has any value. So I'm the worst, like, momentum trader in a sense, because it's like inherently go against my nature, I think, especially when you learn what value is. So I mean, I don't plan to ride the beta place. First of all, it's not a big position. I just can't help myself buying alpha when I see it. But I would prefer margin of safety nowadays. So I mean, my favorite stocks right now is still beta, margin of safety. They have something, or will probably have something. There's a few exceptions of really good exploration stories, but they have a long runway to grow. Because I'm bad at timing. I hate the feeling where it's like you ride something up you think is worthless. Oh, let's say you're up 100% and you're thinking, I probably can get 200-300%. And then let's say there comes a sentiment swing to the downside again, and you're back to square one, and the company hasn't created any value and it's still worthless. I just hate that feeling. So it's like I'm very active in terms of due diligence right now, because I probably said this a bunch of times before. If a stock goes nowhere on a good news item, that might mean that you get 100% extra expected returns in the future. If a story with no bad news goes down 20%, that might add 100% extra expected future returns. And this is in a low liquidity environment where one dude can put out a $3,000 sell and have a stock down 20%. I mean, it's not easy to buy a big position at those prices, but that's why it's like you have to really prepare early, because it's hard to get in a story. It's like it's a mirage, these stock prices, in a sense, because like I can't just, it's selling at whatever, 15 cents. Oh, that's cheap. I'm going to get in. It's like, yeah, there's 2,000 shares for sale. So, I mean, it could take weeks to get in at these prices. So it's like a fake market in a sense, because there's no way anybody can get in any volume in any hurry at the prices we're seeing. But I'm constantly on the lookout. I can sell my beta very quickly if I find something actual alpha quality that is selling, way too cheap, that I just can't pass up on. But I mean, timing wise, I do think I'm looking at some beta charts, and it's like they're down 90%. I think they have a long of runway. I have no doubt people are going to make a lot of money in beta from here. I just know myself that I can't stick it out for the big moves. I can't stick it out in the stories I think are going to go up in value, where I think there's also a margin of safety.
Well, just one more quick follow up on the beta side of it. Alpha stocks are more obvious. They're creating a catalyst. They're creating value by doing something meaningful, either a drill program or expanding resources or an economic study, or they're de-risking a project. So you can see something happening. But the beta stocks, I wouldn't say they're all worthless. There's a lot of companies that have gone out and they, in the previous times, let's say over the last decade, they were the drill plays of old. They were the market darlings in 2016 or 2017 or 2018. They were the companies that went out and developed millions of ounces of gold, maybe tens or hundreds of millions of ounces of silver. Maybe they found a lot of copper. And the problem is they ran out of money over time, but all of those ounces are still in the ground, but they're being valued at almost comical levels. And so at one point, when I think of beta, I think of those ounces in the ground, or those pounds in the ground, if they're base metals, eventually getting re-rated up when other companies, larger companies, start saying, hey, wait a minute, this is a good deposit. You got 2 million, 3 million, 4 million ounces of gold. Not all millions of ounces of gold deposit are the same. It depends on how you're going to mine it. Is it at surface? Is it underground? There's a lot of nuance. But in general, there are such low valuations in the sector right now. I think of beta plays as companies that have already done a lot of work in the past that are eventually going to get re-rated higher for the prior work they've done. What do you think of that idea?
No, absolutely. It's like there are deposits out there. I mean, we know that every single mine in operation today will, I mean, be empty some point in the future. And if we're having a harder time finding these, the tier ones of old, what does that mean? Well, the tier twos of today is going to be the tier ones of tomorrow, in a sense. So I mean, that's a good thing at least. There's like, I mean, it's not like there's a big inventory of really good deposits. I mean, we're not finding a lot of gold rushes and stuff like that. So I mean, I think given the supply demand picture, all the beta is kind of creeping up in value, even though it doesn't show up in price in the short term or anything like that. It's the same as one of those big copper tier one copper mines of yesteryear, or the old timers. They needed what, 15 grams per ton gold. Today it's like, oh, we're mining 5 grams per ton underground. So I think beta has a lot of going for it over the long term, simply because the lack of really good discoveries. And I surely think there are a bunch of projects that might not be, well, they're trading like trading sardines, but they are legit projects. And at these gold prices, I can only imagine how many actually work, but they're priced like they have a 5 to 10% chance of actually working. So I think there's good beta out there. I do prefer, and a lot of them have it, like they also have some alpha. They can still grow, because when I'm thinking a pure trading sardine, that's like a project that's very mature, been around for 20 years, never seems to be going anywhere. Nothing changes. There's no way to really add value. That might also become a mine one day. But I would prefer, it's like, I own a few beta stocks where it's like, I legit think they have, some of the best deposits around. So in that sense, yes, they are worth something, but still, if they don't get acquired or built, they're still going to be trading as a trading sardine based off that. So if they miss the cycle or whatever, and nobody buys them at near the top, whatever, they're going to go down. And of course, there's the ones who are like, they have a legit project, but they're getting snatched up right now. I mean, we've seen some who get snatched up right now. So obviously the market was kind of wrong, because they were pricing in that they didn't have anything, but still they had something, but it still wasn't sexy enough for the time being, or they didn't have enough interesting catalysts to actually revalue, to have a nice dangling carrot in front of the Mr. Market. So I mean, it's a good question. So it's like, I mean, when I'm talking beta, I mostly mean that they have some kind of proven ounces. And when I'm talking, pure beta trading sardine, that's the ones where it's like, who knows if they're ever gonna, I mean, let's say high capex, they're never gonna build it themselves. There's like very, if somebody's gonna build it within the next 10 years, those are the ones you have to be really careful with. Otherwise, I mean, yeah, the beta, the tier twos of today, they're getting closer to tier ones by the day.
I think that's a great point. I think that eventually some of the projects that are seen as tier two keep growing, especially if they're maybe a hybrid, an alpha beta play, let's say, where they're a beta play in that they have a lot of ounces or pounds in the ground. They've already done a lot of work. They've defined it, but they have alpha in that maybe they're finding a new satellite pit that's higher grade. Maybe they found a new area of the deposit at depth that really spikes the underground mining scenario. Maybe they found a hub and spoke method where they picked up some other land, and while they have these ounces defined on one project, they now have 2 or 3 satellite deposits going around it that could feed a central mill. So maybe a company that's got a mix of alpha and beta is that sweet spot. I think it's an interesting concept, man. We'll wrap it up here today. It's just kind of fun to talk about the markets, what you saw from PDAC, what you're seeing in the sentiment right now in the space, and how you're looking at the lay of the land as an investor in the sector. If people like getting Erik's thoughts, definitely click on his link that takes you over to theheadlesshorseman.com. He usually writes up the companies he's following, as well as ranting on the sector and what he sees out there on the micro side of valuations and mismatches in valuations. And Erik, it's always great having you on the KE Report, getting your thoughts on how you're playing the resource sector.
Thanks for having me, Shad.